Welcome to the deep dive. Let's get straight to it. Commercial real estate tax laws and deductions.
Yeah.
For business owners with commercial property, look, this can feel like a really complex area.
Oh, definitely. Overwhelming sometimes.
But underneath that complexity, a serious opportunity to save money, a real opportunity. And that's what we're here to uncover.
Absolutely. I mean, many business owners are, you know, understandably focused on just running their businesses day to day.
Of course.
And the intricacies of CRE taxes, they can often take a backseat. But understanding these rules is truly essential for maximizing your financial efficiency.
Exactly. So for this deep dive, we've looked at, well, a whole range of sources.
Yeah.
Everything from how real estate pros and investors find deductions, the nitty-gritty of capital gains,
Yeah, that's a big one.
the limitations you need to watch out for, and even some smart ways to potentially lower your actual property tax bills.
Right.
So our mission today is really to pull out the key actionable insights. We want to help you, our listener, understand what's most important in CRE tax law and, crucially, identify deductions that could really impact your bottom line.
Let's do it.
Okay, so let's dive right into the basics then. What are the sort of core principles of commercial real estate tax laws that we need to get our heads around first?
Well, at its heart, commercial real estate tax law dictates how the IRS taxes the commercial properties your business owns and operates.
Okay.
But maybe more importantly for business owners, it outlines which expenses you can actually deduct. And that ultimately reduces your taxable income.
Right.
Think of it as the framework.
Yeah.
You know, it governs your tax obligations, but also shows you the potential routes for tax relief.
And this isn't something you learn once and you're done, right? These rules aren't set in stone.
Not at all. Tax laws are, well, they're dynamic. They evolve.
Constantly changing.
Exactly. New legislation comes in, interpretations shift. What was a valid deduction or a specific rule even, say, last year might have changed. That's really why staying informed and, frankly, getting up-to-date advice is just so critical.
Right. So vigilance is absolutely key. Okay. Now, let's talk deductions, the good stuff. The opportunities to keep more of your hard-earned cash. Where should we begin looking for those potential savings?
Well, a really fundamental area is just understanding what the IRS considers necessary and ordinary business expenses.
Necessary and ordinary, like what?
It covers a really broad spectrum of costs, things that are common and, helpful for running your business. So think about your advertising and marketing, getting clients or tenants, the essential utilities keeping the place running, electricity, water, internet.
The basics.
And even just the everyday office supplies you burn through, paper, pens, that kind of thing.
So the regular costs of just doing business, essentially.
Precisely. But and this came up in the sources, here's a crucial point. Meticulous record keeping. It's just non-negotiable.
Right. You always hear that.
You really need solid documentation. We're talking invoices, receipts, contracts, proof that these expenses were necessary and that they actually happened. If the IRS asks, you need that backup.
Got it. So no more shoeboxes full of crumpled receipts. Organized records are the absolute foundation.
You got it.
Now, what about those folks who primarily invest in commercial real estate? Maybe they don't run their main business from it. Are there different or maybe additional deductions they should be focusing on?
Oh, absolutely. For real estate investors specifically, there's a significant set of deductions available. A big one is depreciation.
Depreciation always sounds a bit theoretical.
It can seem that way, but it's powerful. It lets you gradually deduct the cost of the building itself over its useful life. It's basically the IRS acknowledging that the asset, wears down and ages.
Okay.
Then you've got the interest paid on loans used to finance the property. That's often a very substantial deduction.
I bet.
And, of course, the direct operating expenses, things like repairs to keep the property in good shape, general maintenance costs. All of these can significantly lower an investor's taxable income.
That depreciation point, though, it's not like you're physically handing over cash each year for that wear and tear, is it?
That's a great way to put it, actually.
Okay.
Yeah. Depreciation for tax purposes is a non-cash expense.
Right.
It's more of an accounting mechanism the IRS allows. It recognizes assets have a limited lifespan, their value diminishes, at least on paper, for tax. They have specific schedules, for how different types of commercial property can be depreciated.
So it's not necessarily tied to the actual market value fluctuations year to year?
Not directly, no.
Yeah.
It's more about spreading that initial cost of the asset over its designated lifespan, purely for tax purposes. And as we saw in the research, staying on top of the current depreciation rules is really key. They do change.
And our sources mentioned how investors can really maximize these deductions, particularly looking ahead to 2025. Any specific strategies that jumped out?
Yeah, definitely. Beyond those core deductions like depreciation and interest, investors should really look into cost segregation studies.
Cost segregation, what's that?
Well, what's fascinating here is that these studies, they break down a commercial building into its individual components.
Okay.
Think specialized flooring, maybe the electrical systems for specific machinery, certain types of lighting. And many of these smaller components actually have shorter useful lives for tax purposes than the main building structure itself.
Ah, I see.
So by identifying these, you can actually accelerate the depreciation, take larger deductions in the earlier years of owning the property.
Faster write-offs.
Exactly. Also, just diligent management and, again, documentation of all eligible repairs and maintenance is crucial. And, always keeping an eye out for any new tax incentives or programs that might pop up.
Okay, so for investors, it sounds like really digging into the details of their property, its specific parts, can unlock some pretty significant tax benefits.
It really can.
Now, what happens when it's time to sell that commercial property? That's when capital gains tax looms large, doesn't it?
Exactly. Yeah, that's when it kicks in.
Yeah.
When you sell a commercial property for more than its adjusted basis,
Okay, what's adjusted basis again?
think of it as your original investment, plus any capital improvements you've made, but minus any depreciation you've already claimed along the way.
Got it.
If you sell for more than that number, you generally realize a capital gain, and that gain is subject to capital gains tax.
Ouch. So if you've held a property for a while and it's really gone up in value, that could mean a pretty substantial tax bill hitting all at once.
You could, yeah.
But our sources pointed to some ways to potentially lessen that immediate impact or defer it.
Absolutely. One of the most powerful tools out there for deferring capital gains tax is the 1031 exchange, sometimes called a like-kind exchange.
The 1031, heard of that?
Right. This lets you sell a commercial property and then reinvest the proceeds into a similar property, a like-kind property, within a very specific time frame. And if you do it right, you essentially hit the pause button on your capital gains tax liability.
Pause button, I like that.
Yeah. It's not that the tax disappears forever, mind you, but it's deferred. It allows your investment to keep growing without that immediate tax hit.
So just to be clear, you could sell, say, an office building and buy maybe an apartment complex. And provided you follow the rules, you wouldn't immediately owe capital gains tax on the office building sale.
That's the idea, yes. It's a huge advantage for continued investment, a very widely used strategy.
But I sense a but coming.
Well, yes. It's absolutely critical to adhere strictly to the IRS rules. There are very specific timelines, for instance, for identifying the potential replacement properties and then actually acquiring one.
Tight deadlines.
Very. Missing those deadlines can invalidate the entire exchange. And boom, the tax liability is triggered immediately.
Okay, definitely sounds like an area where you need good advice, professional help.
Without question.
What about these opportunity zones we've been hearing more about? How do they fit into this capital gains picture?
Right? Opportunity zones. They were created a few years back to encourage investment in designated sort of economically challenged communities.
Okay.
And they offer some pretty compelling tax advantages, specifically related to capital gains. If you invest capital gains from selling a property, stocks, whatever, into a qualified opportunity fund within a certain time frame,
Yeah.
you can potentially defer those capital gains taxes. And depending on how long you hold that investment in the opportunity fund, you might even eliminate a portion of the original gain tax, or potentially even eliminate all capital gains tax on the appreciation of the opportunity fund investment itself.
Wow. Okay. So hold it long enough, like 10 years, I think?
10 years is the key time frame, yes.
Mhm.
Hold it for at least 10 years, and any appreciation on the fund investment itself could potentially become tax-free. It's designed as a win-win. Tax benefits for investors, plus stimulating economic growth in those targeted areas.
Interesting. A potential double benefit there. And the sources also flagged up installment sales as another way to manage these taxes.
Yes, an installment sale is basically a technique where you don't receive all the money from the sale of your property at once.
Okay.
Instead, you receive the proceeds over a set period, maybe several years. This lets you spread out the recognition of your capital gain and therefore your tax liability over those same years.
So it smooths out the tax hit.
Exactly. It can be Particularly helpful if you're looking at a really large capital gain.
Yeah.
It just eases that immediate tax burden.
Okay, so some really useful strategies there for dealing with capital gains when it's time to sell. Now, we also need to be realistic, right? We need to talk about the restrictions that exist in CRE tax laws. It's not all just finding deductions.
That's very true, yeah. Current tax laws, and especially recent changes, do impose certain limits on what you can actually deduct.
Like what?
One significant area our sources highlight is the limitation on deducting business interest expense.
Interest expense, like on mortgage.
Exactly. There are rules that can restrict the amount of interest a business can deduct on its debt, and that includes mortgages on commercial properties. These rules can get quite complex, often depending on factors like the size of your business, your gross receipts, things like that.
So just because I'm paying, say, $50,000 a year in interest on my commercial property loan doesn't automatically mean I can deduct the full $50,000.
Precisely. There can be thresholds and calculations involved that might limit the deductible amount for certain businesses. Businesses really need to be aware of these potential limitations to, well, accurately project their taxes and make informed financial decisions.
Okay, that's a big one to be aware of. Now, we talked about depreciation earlier as a benefit. Are there any restrictions or maybe less favorable rules tied to depreciation we should know about?
Yes. While depreciation is definitely a valuable deduction, the recovery periods, that's the number of years over which you depreciate a property. They can be quite long for certain types of commercial real estate. For example, the standard recovery period for non-residential real property is typically 39 years.
39 years. Wow, that's a long time to spread that cost out.
It is. And furthermore, tax laws can change. Sometimes they adjust these recovery periods, or they might tweak the specific methods of depreciation allowed. So it's vital to understand the current rules that apply to your specific type of commercial property for accurate tax planning.
Okay, so potentially very long timelines for writing off the building costs, meaning that tax benefit is spread pretty thin each year. Now, one of our sources mentioned something interesting, that in some cases, business owners might strategically choose not to take certain deductions or might elect out of certain limitations if it actually helps their overall financial picture. That sounds a bit counterintuitive. Why would you not take a deduction?
That's a very insightful question. Yeah, it does sound odd at first. But in certain specific scenarios, electing out of a limitation, like those interest expense deduction limits we just talked about, might actually allow a business to take advantage of other tax benefits that would otherwise be restricted.
How so?
Well, making that election often comes with its own set of rules or trade-offs. For instance, electing out of the interest limit might require you to use a longer depreciation period for certain assets, like the ADS system, the alternative depreciation system.
Ah, okay. So it's a trade-off.
Exactly. The decision to make such an election is highly dependent on the individual business's complete financial situation, their income, their other deductions, their future plans. It really should only be made after a very thorough analysis, and almost certainly with the advice of a qualified tax pro who can model it out and weigh all the potential benefits and drawbacks.
So it's not about maximizing every single deduction in isolation.
Right. It's about optimizing your overall tax liability across the board, seeing the bigger picture of how all the pieces interact.
Makes sense. Okay, let's switch gears slightly again. Let's talk about strategies for reducing commercial property taxes. This is different from the federal income tax we've been discussing, correct?
Exactly. Totally separate. Commercial property taxes are levied by your local government, city, county, etc., and they're based on their assessed value of your real estate.
Right. And for many businesses, these can be a huge expense.
Oh, yeah. They represent a significant ongoing operating cost. But the good news is there are legitimate ways to potentially reduce them.
And the main way to do that is by appealing the assessed value. Is that right, as I understand it?
Yes, that's the primary method. The process generally involves, first, carefully reviewing your property tax assessment notice when you get it,
Okay.
then comparing that assessed value to the actual market value of your property, and also looking at similar properties in your area. If you can build a strong case that your property has been overassessed.
How would you know?
Well, maybe there are inaccuracies in the assessment data the county used. Perhaps local market conditions have changed significantly since the last assessment. Or maybe there are physical issues with your specific property that weren't accounted for. If you find evidence of that, you likely have grounds to file an appeal.
So it's really about doing your homework, gathering solid market data, maybe getting an independent appraisal, and then presenting a compelling argument that the local government's valuation is just too high.
Precisely. Presenting concrete evidence is absolutely key. Things like recent sales data of genuinely comparable properties, an independent appraisal report, like you said,
Hmm.
or documentation of any factors that negatively impact your property's value, maybe significant physical deterioration or something called functional obsolescence.
Functional obsolescence, like what?
Maybe the building layout is really outdated or it lacks features essential for modern businesses in that sector, making it less desirable or usable. That can lower its true market value. Pointing that out is crucial for a successful appeal.
Okay. And let's say a business owner is successful. They go through the appeal, they win, they get their assessed value lowered. What's the direct impact on their finances?
It's pretty straightforward. A lower property tax assessment directly translates into reduced operating costs, lower tax bill.
More cash flow.
Exactly. This can have a really significant positive impact on your property's cash flow and its overall financial health. And those savings, well, they can be reinvested back into the business, used to pay down debt, or simply improve your bottom line.
Sounds like it could be a very worthwhile effort if you have a legitimate case that the assessment is too high. Are there any specific deadlines or time sensitivities involved in this property tax appeal process?
Absolutely, yes. There are typically very specific and often quite strict deadlines for filing property tax assessment appeals.
And they vary.
They can vary quite a bit, depending on local jurisdiction, the city, the county. It's absolutely crucial to be aware of these specific deadlines in your area and to act promptly if you believe your property's been unfairly assessed.
What happens if you miss it?
Usually, if you miss the deadline, that's it for that tax year. You typically have to wait until the following tax year to pursue an appeal, potentially missing out on a full year of immediate tax savings.
Okay, so timely action is really essential there. Got it. Now, as we start to kind of wrap this deep dive up, let's circle back to you, our listener. Based on everything we've covered quite a lot, what are the key takeaways, the actionable steps you should be thinking about right now?
Okay, first and foremost, and I know we've said it, but I really can't emphasize this enough, maintain meticulous, well-organized records.
Number one.
Every single piece of income, every single expense associated with your commercial property, it is absolutely fundamental. It's the bedrock, really, upon which all your deductions are claimed and justified.
Agreed. If you can't document it, it's almost like it never happened in the eyes of the IRS. Okay, what's the next critical step?
Second, it is really highly advisable to consult with a tax professional who specializes specifically in commercial real estate.
Not just any accountant.
Well, ideally someone with deep CRE experience. The intricacies of these laws, the regulations, they can be considerable. A knowledgeable advisor can provide tailored guidance for you, ensure you're fully compliant, and help you identify all the potential deductions relevant to your unique situation. And they can really help with those more complex strategic elections we talked about earlier.
Makes perfect sense. Finding a specialist in this niche can provide real clarity and direction. Okay. And for those listeners who are primarily real estate investors, what should be at the top of their to-do list?
Right, for the investors. It's crucial to actively investigate and thoroughly understand those strategies aimed at maximizing deductions.
Be proactive.
Yes. Explore the benefits of things like cost segregation to maybe accelerate depreciation. Diligently track and deduct all your eligible interest expenses and operational costs. And seriously consider the potential advantages of using 1031 exchanges to defer capital gains when you sell. And also look into opportunities on investments if they fit your strategy. Check out their potential tax benefits in those designated areas.
So it's about being proactive and really strategic at every stage of ownership, from buying to operating to selling.
That's it.
And for all business owners with commercial property, regardless whether they're mainly investors or owner-occupiers.
For all commercial property owners, just staying well-informed about any recent changes, any current restrictions in CRE tax laws, like those limits on interest expense deductions we discussed, or the specifics of current depreciation rules, is absolutely essential. Being unaware of these rules can lead to some really costly errors or missed opportunities.
Knowledge truly is power, especially when you're navigating the tax landscape. And finally, regarding those property taxes we just covered?
Yes, finally, every single commercial property owner should at least understand the process of appealing their property tax assessment in their local area.
Know your options.
Exactly. Regularly review your assessment when it comes in. Be prepared to gather evidence and present a well-supported case if you genuinely believe your property has been overvalued. It can lead to significant savings on those annual property tax bills.
Excellent summary. So it sounds like a comprehensive approach. is really what's needed here. You need the detailed record keeping, the expert guidance, strategic planning around your specific property and goals, staying current with regulations, and being proactive about local property tax assessments.
Precisely. I know it might seem like a lot of moving parts, but honestly, each one of these areas presents a tangible opportunity to potentially achieve significant tax savings and improve the overall financial performance of your business related to its real estate.
So we've completed our deep dive into the, let's face it, often complex world of commercial real estate tax law. We've really tried to highlight why understanding these aspects is so critical. It's not just about staying compliant, is it?
Not at all. It's about actively minimizing your tax obligations and ultimately boosting the financial returns from your commercial real estate.
Yeah, while the details can sometimes feel overwhelming, taking that proactive and informed approach to your commercial real estate taxes can truly make a substantial difference. It affects your business's profitability, its long-term financial well-being.
Absolutely true.
So as you, our listener, reflect on our discussion today, the importance of keeping those meticulous records, exploring specific deductions like depreciation or interest, really understanding the mechanics of things like 1031 exchanges or opportunity zones, staying informed about recent regulatory changes, and maybe even considering whether appealing your property tax assessment is a viable path for you. You really think about which one of these strategies might present the most immediate, the most significant opportunity for tax savings in your specific situation.
Find your starting point.
Exactly. That's your path moving forward. Identify that key area, maybe just one to start, and begin to explore it in more detail. Thanks for joining us for this deep dive.